Hey everybody, Tim Harrison, Straight Up Mortgage Talk, and today I'm super excited to have Susie Gomez from our actual Cornerstone team. She's one of the best underwriters I've ever worked with, and I've worked with a lot of great ones. And the main purpose of this today is to have you understand what an underwriter's role is, why it's important, and just really not be fearful of the underwriter. So let's get started and let's meet Susie Gomez. Hey, Susie, thanks again for being on. I really appreciate you bringing the underwriting prospect or sort of, I don't know, vision of like what happens in there. Explain this to my realtors and clients. I want them to actually know like you're a person, because I think people think like some underwriter is some big bad person up there, you know, ready to stamp denied on a file. And I really like that you're coming on because you have the experience of, you know, really being a loan officer, being in the field, dealing with customers, realtors, and referral partners, and now being an underwriter for a long time. And so you have a different perspective than a lot of underwriters do. So again, thanks for coming on the show.
Absolutely. Thanks for having me on.
Awesome. All right, Susie. So the first one I want to know is like just kind of an overlay. What does an underwriter do? So for those, you know, we're talking about first-time home buyers who a lot of times going to listen to this and they just don't understand the process. And I'm trying to do videos to sort of break up like, hey, what happens? What are they looking at? And part of it is not to be afraid of the process, but just things like, what does an underwriter do? And what are they sort of looking for to approve a file so that people can have a home?
Well, Tim, basically what we do is when a loan application comes in and we're looking at the information that's presented on the loan application, we'll look at, say, the borrower says that they've worked at Walmart for 10 years and they make $5,000 a month and they have $50,000 in the bank. What we will do is the loan officer will take all those inputs, right? And they'll enter them into our automated underwriting system. And what we do is we review and analyze all the information that's presented to us. So your employment information, so your pay stubs, your W-2s, your credit reports, your bank statements. We'll review and analyze all of that, and we'll kind of You'll hear some repetition from me on this, but we will reconcile it against the inputs that you entered into the automated underwriting system, just to make sure that whatever decision our system generated is accurate based on the information that was provided on the 1003. So we are about the risk analysis and just making sure that the information that's provided is accurate, and our investors get what we input into our systems.
Right. So basically, we loan officers just say, well, they were super nice, approve them, and we put the information in and we do some income calculations, and we basically have to go to an underwriter to make sure that, one, we didn't miss anything. Two, the real integrity of the loan process is that the underwriter makes sure that that credit, income, collateral, all that stuff is accurate, or these investors won't buy these loans, and then we won't be able to do loans, or the banks won't, you know, take those loans on. So you as the underwriter really sort of the clearinghouse between the originator and the front consumer to pass through to make sure that file is what we all think it is and what the investors willing to accept, say a Fannie Mae, a Freddie Mac, an FHA or whatnot.
Exactly. Yes.
So I'm just kind of clarify that, because that's so critical. It's not like the underwriter is not making some sort of decisions for themselves, whether they like you or not, or any of that kind of stuff when it's going through underwriting. They have very specific guidelines. And can you kind of talk about that? How you have to have a super big brain. You know, you look super sharp there. You got the great look, the hair. You even put lipstick on today for us because you're going to be on this podcast. But the real world is like you have to have super big brain, because you have all these different investors that you're sort of underwriting, and they can change what they want from you, from us, right?
I don't think I need to have a big brain. I just need to have a reference point. So
you're a modest person.
The investors generally provide us guidance, and that guidance changes frequently. So yes, you guys get to deal with the changes. Like, oh, sorry, this is new. You've got this new condition, so you get to deal with.
We love those calls.
Yes. But we have reference points where we go in and we look at information. So, for example, somebody's part-time. So we'll go in and reference what does the FHA say about a part-time employee and how we calculate their income and how long they have to be on the job. So we will go back and reference what FHA guidance is on that and what their requirement is to make sure that our borrower meets those requirements. And that's for every investor, FHA, Freddie Mac, Fannie Mae, USDA, every VA, everybody has a reference point that we can access.
Right. And because those guidelines can change frequently and because they have to be interpreted, because, it's like one of those government tests, they're not always like clearly like blunt, here it is. A lot of times I have to come to you and go like, what the heck does that mean? Right. I mean, I have a client here and that's what people don't know is like, you're my primary underwriting for my branch. So we talk a lot when I'm saying, hey, can I do this? Can I do that? And a little selling point for me and my branch and having Susie on our team is that I get to check those things up front. I don't have to wait, 20 days later, halfway through the process to find out that I didn't interpret something correct. If I have any question, I can pick up the phone or send it to you. And you are very quick because, again, you say you're not smart, but you know where to go get the guidelines, how to interpret them, and help me say, yeah, I think you can do that, or no, I think you need this or that. And that's super helpful. What people understand is the underwriters really want to make the deal work, right?
Absolutely.
I mean,
absolutely.
You're not some mean, grueling, horrible boss out there on the video game trying to crash down and tell them not to get the loan. You want to make it work. Your concern is that it's kind of your butt if the investor doesn't purchase the loan. And I say that, and that's not the word we would use in the industry, but you're the clearinghouse, and that comes back on you if we don't make sure it meets the guidelines for the investor, basically.
Correct. We want each investor we want to package and give the investor exactly or fairly close to, what they're looking for when we're doing these loans.
Yeah. So, this is kind of a weird question, but, this is from the standpoint of my processing staff and myself, and we have to bug clients for stuff. And of course they love us for that. Like, oh, we need this and we need that. And then we do third-party verification. We're looking at bank statements, we're verifying employment. Why is that those documents and that third-party verification important to the process?
Well, the third-party verification is critical in certain ways. For example, the verification of employment. When we do that final verification of employment with that third party, if there's any changes or any significant changes to the employment, obviously that can completely change whatever structure of the deal that we had. So that's why those documents are extremely critical. I mean, if you have a borrower that all of a sudden had a job change and forgot to tell us, and we call in, we do a verify. I've had those, Tim, where I'm like, he no longer works there. What's going on?
Yeah, I like it when I get that call. Oh, really? Let me call them. I didn't know.
And they started a new job and they just forgot to tell us,
or they're afraid it might affect things, or they don't know. So they kind of like, note to everybody, we're going to find out. Tell us ahead of time. It will mean we won't have a delay in it, because the delay in the closing, because we can actually address it early on. Maybe even call me before you take the job to make sure that the change in income is not going to impact your ability, and do it after. Just saying.
Yeah, so that's why those documents are critical, is because we want to make sure that that whatever we have verified is still accurate at the very end. Also, the other item that we sometimes will require, And it depends on the investor, or sometimes there's maybe a discretionary reason that we may need it is tax transcripts for a self-employed borrower. So on occasion, we may need those, but we don't see that too often. But those are usually the third-party documents that we are asking for.
I'm going to, because she's way too nice, I'm going to tell you the other reason the industry has to do it is that the loan industry is backed by the financial government and all its power and all this kind of stuff. It's also, unfortunately, because so much money can be involved in buying real estate, making money on real estate, it can be wrought with fraud. And one of the problems and one of the major issues we have to do, which really frustrates me because the fraud can be a very low percentage of the time, but we're making the 99%, then the 99.9% of the customers uncomfortable and having to hop through the hoops of what we have to verify, because unfortunately, the small amount of fraud is super costly to the industry. So one of the things Susie just mentioned is this 4506 you'll sign so that we can get tax audits on self-employed. Well, I started at Dun & Bradstreet before I got in the mortgage business, and the people owning companies used to joke about how they had two sets of taxes, one for the bank and one for the IRS, where they wrote off everything. So the reason a lot of these third-party documentation is required is, one, to make sure everything's actually accurate and legit, because again, and we're sorry that we have to put the good people, which is 99.9% of the people, through the pain. But the issue is fraud on a file could be $100,000, $200,000, $300,000 problem for the industry. And let's remember, the underwriters and us, these investors, Fannie Mae and Freddie Mac, they sell mortgage-backed securities back to our retirement accounts. We're reloaning your own money in many cases. We're there to protect and make sure that that investment that you think is going to pay for your retirement is a good investment. And so it's our responsibility as an industry to make sure these things are legit and not going to be a problem and cause some sort of decline in your retirement income or investment. So I like to tie that in, because what people don't understand is we're basically loaning their money back to them in a sense, right? Their retirement accounts are the ones buying these mortgage-backed securities. And then it feels a little better, like, hey, we're not only are we protecting the industry, but we're potentially protecting consumers. We're not a big bank that sits there and holds these loans. These are sold off to investors that buy this product. And again, mostly in our retirement funds. So just sort of full tie in there so people really understand that, because it's a little bit confusing to understand why we have to go through that third-party documentation and screen stuff, even, with, a lot of money down, perfect credit. And you're right. We can look at the file and go, yeah, they're never going to default, but we have guidelines to follow, and we just have to. So unfortunately. All right. So automated underwriting, you talked about it a little bit, verifying. So Fannie Mae has their own system. Freddie Mac has their system. FHA uses a system, put it through an automated underwriting. So you put all this data in, it takes the credit, it takes the income, and then it spits out and says, hey, if all this stuff is true, and you have an approved loan. Basically, all the underwriter has to do is verify this information. And what I always tell my realtors is that good input in means good output, right? But bad information in, and you can't verify it, because they ask me to do a lot of cross qualifications, for example. So this is for my realtors out there that says, hey, can you make sure we protect my seller and, do a cross qual? And they'll say, well, they have a DU or they have an automated underwriting. It's good. And I'm like, well, it depends, right? Because that's the process that you go through. Kind of talk about what happens. And I guess the term is validating the information is actually accurate, because it's not like the computer puts that information, a person making a decision what that income is or what they think it is or whatnot's making that decision, whether being at the job for 2 years, that kind of thing. Correct.
So just like, as you said, an automated underwriting decision is only as accurate as the documentation that's provided to support it. So my job as an underwriter is to go through all the financials, go through the credit report, go through the bank statements, the tax returns, the W-2s, the letters of explanation, go through every single piece of documentation that you've given me that's going to align to that automated underwriting output. right? So so my output says that you have Social Security income, then that's what I'm going to look for, right? When you enter it. Or my tax return, say you've been in business for 12 years, and then I look at your tax returns and it says only 2 years. Well, that's kind of going to change things, right? Because a person that's been in business for 12 years has more longevity. They're considered a little more stable because they've been around longer versus the person that's been around for 2 years or 3 years.
And worst case, I hate to cut you in here, but this is a big deal on a cross call, right? Because if they put 12 years and you can't verify that, we know that we can get a 1-year tax return,
Correct.
which we like to use a lot of times.
Yes.
Because maybe the year before wasn't as great or whatever. We like to use that 1-year tax return, but if they don't have the 5 years in business, and I believe maybe even at that location, it kicks it out to a 2-year. And now all of a sudden that could change your income enough to blow the deal.
Correct. Because if it was your startup year and you had very little income that year, now you're averaging over 24 months, and where you were saying you were making $10,000 a month, and your prior year could bring down that average and bring you down to $3,000 a month. It's right. Something that drastic. So your entries are extremely critical. And again, and sometimes if your credit scores are not that high and you're getting an approval, if you're giving me assets, and I've seen this numerous times, where
I'm so glad you're addressing this,
where you've got maybe, a slightly lower credit score. And you say you've got, 50,000 and you're going to have 12 months in reserves. And then when we actually verify your bank statements, you have enough to close and maybe 1 month of reserves or 0 reserves left. Your approval may turn into a denial because automated underwriting was approving you because of the reserves. Right. When you had the lower credit score. So there's a lot of factors that go in there. So whatever inputs or whatever information you provide should be accurate so you can get an accurate answer. And that's what my job is to make sure that everything you said in your 1003 is accurate, and every entry that was put into the automated underwriting system is accurate. If there's any variation to that, then normally what I'm doing is I'm making changes and then I'm rerunning it to see what the actual disposition is. And at that point, I may have a call to the loan officer to say, oh, we have a little problem here. So
the two worst words we hear from the underwriter are, I have to suspend your file because there's not enough documentation for me to make a decision, or I have to decline your file because you completely missed something. So we try to be really thorough and not have that. And by the way, Susie, you love making those calls or sending those emails as much as we like receiving them, huh?
No, I don't like them at all.
Just I want people to still know underwriters are human beings. That they actually feel too. They know people are excited about the house and they don't want to burst somebody's bubble. Couple clarifications because we tend to do industry speed. 1003 is the loan application, and reserves, when she's talking about reserves, is PITI, principal, interest, tax, insurance, and A if you have an association. So PITIA. So what they're looking for when she's talking about those reserve requirements on a automated underwriting, that may give you an approval, and then all of a sudden you don't have enough reserves. What the underwriting system is looking at for many times is either a 2 months of PITI and reserves after close. I mean, after we stole all your money for the cash to close, they still want to see that you have money in there. This is what my stepdaddy always called. They want to make sure you have a pot to piss in after the fact. They don't want you to all of a sudden lose your job or have a cut in overtime, and all of a sudden you can't pay your mortgage because you don't have any reserves to rely on. So reserves are critical to those life changes that people go through. And just coming out of COVID, people can really understand that depending on what industry they were. Reserves are really critical in somebody keeping a home. And so the automated underwriting systems know that. And just to explain a little bit how those automated underwritings are set up for us to get approvals is that Fannie Mae and Freddie Mac are pretty much every loan out there, with the exception of jumbo loans. So that's probably 80+% of the industry. Those approvals are running through some sort of automated system. They also service a lot of these loans, meaning buy them, and they know who pays and who doesn't pay. They have huge amount of statistical data. So when they come back and they say reserves make a difference, they know reserves make a difference because they know that this million people over here that they got a loan that didn't have reserves defaulted and lost their house, and this million people that had 6 months reserves didn't. This is built on absolute statistical probability, just like credit scores are. And so that goes into that system that we're validating. It's not things that people make up. It's hard data, and they have a ton of data to make those decision points on. So just so you know, what we're verifying in our process, and what Susie and the underwriters are verifying, is based on statistical data of success or failure. There's always exceptions to those rules, but when you're doing millions and billions of loans, you don't always get to go through there. That's where an underwriter, and to kind of discuss that a little bit, can kind of say, hey, this doesn't fit guidelines exactly, but I can sort of verify this or know that this was an anomaly in the system. And we had a lot of those kind of decision making with COVID, because people's income dipped for a period of time to return back to normal. Explain, like, when it's sort of not off the beaten path, but it's like the gray area, right? Where you go, it makes sense. How do you kind of go through that process? It's not always black and white.
Well, even in those circumstances, the investors will give us guidance around that. They'll say, for example, if somebody if they've been on a variable job, and it hasn't been quite the 2 years. Of course, it all depends on your investor.
Correct.
If it hasn't been quite the 2 years, you can make that exception of, say, 12 to 24 months. So
Okay.
they'll give you what your gray area is to play with typically. Anything outside of that, then it's difficult. It's difficult to say, and you've got other people involved in that decision-making process.
And mostly, like, credit is kind of cut and dry to some degree. Like, the automated
Right.
system either likes the credit or doesn't like the credit. The income, though, is one where people really have a tough time understanding it. So can you do me a favor and kind of discuss the variable types of income and how you kind of have to underwrite those, to give people just a brief example of that? And then, honestly, like, when it comes to income, self-employment, and I guess that, I think if you address the variable income parts, that's probably going to address most of my sort of the things that really get confusing for people, is that variable commission, bonus, overtime, self-employment. Tell me how an underwriter has to sort of analyze that different than somebody who's got a set salary. We love those, but more and more, we don't get a lot of those.
Right. So the way we analyze variable income may be someone who's in sales where they're commission driven, someone who does contract work, such as like an offshore oil welder who works seasonal and their job changes, or they work for a union where they work different jobs at different times and get different pay rates. Right. So all of that is considered variable. If you're not a straight 40-hour work week at $30 an hour, then and you're paid, you're different from that, and your pay just varies from paycheck to paycheck, then you're going to be considered variable. So the way we turn around and we analyze the variable income is we analyze a 2-year history. Again, 2-year history being critical because we want to see that it's been there and it's going to continue. So that's critical for us. We look at a 2-year history. We look at whatever your year to date is. Obviously, when you're looking at January, February, it's kind of hard to gauge. But as the year goes on, say right now, if I'm looking at May, if I look at your year to date and I look at your 2020 income and I look at your 2019 income, what I'm going to do is look to see that the income is increasing year over year. So that is the most favorable trend, to see the income increasing, or at least steady, where it's stable or steady. Now, if I'm seeing it declining, then I start asking questions. It's like, what's going on here? The income's gone down. COVID last year was a perfect example where people may have had a loss of income. So that, we do see a lot of that explanation now. But aside from that, if we're going to ask for an explanation, for why did the income go down from this year to that year, doesn't mean that they're not qualified. I'm not saying that. We just want to know why is the income down this year versus the prior year. That's it.
Right. Like sometimes it's that letter of explanation, a letter from the employer that we're asking for. And here's why. What you're looking for, the guidelines, right, that are ingrained in my head from early underwriters I dealt with, is that everything is sort of established on the likelihood of a continuance, right? So they look for like likelihood of continuance over the next 3 years. They don't look for 30 years on the mortgage, but they're really looking for that likelihood of continuance. They base it on the recent past, last 2 years. And they look for it for that remaining period of time. Basically, they're looking like, is this likely to continue for 3 years? Beyond that, they're kind of thinking, hey, hopefully people's income are up or whatnot. But that likelihood of continuance is so important. And what we do as loan officers and what we're supposed to do is sort of address those issues. And these are the part of things that clients understand where we're making them miserable. And so it doesn't become a problem at the end of the transaction, and it's addressed it early. And that is, hey, we see there's a dip in your year-to-date income as compared to where it was. What's the reason? Oh, well, my bonus and commissions are heavily loaded to the last quarter of the year. I got to hit quota before I finally actually get the paid money. Great. So because we're looking at last year and you had a $30,000 bonus or commission and you've had, 1,000 or none year to date. And we're like, hey, are you not going to get bonus now? Because you need it to qualify. The other thing too, we'll not use it. Right. We'll as loan officers throw it out of the file and say, if we don't need it to qualify. Correct. But if it's significant, overtime is another good example, right? Overtime, commission, bonus. If we see those dipping, we have to address those with the underwriter, or they're going to ask us to address them. And that's why we try to get those letter of explanation. And again, third party, a lot of times for the employer saying, yeah, our bonuses are end of year. This is when they're paid. And that's why you're not going to see anything now, because that third party, the employer or the tax audits from the IRS are just more believable, because we do have people that really, really, really want the house and they'll say what needs to be said. So we do have to do third-party documentation. So anything else that you see that just sort of makes or breaks deals, or that you feel it's important that an underwriter kind of tells realtors and consumers are going through, there's so much to what you do. There's so much to what makes a good loan versus a bad loan or whatnot. And hopefully we try to weed those out before you get them and work with the clients until they get there. Because I like, I'm going to give Todd Duncan some props here. He was one of the mortgage trainers. He's never say, that it's not going to say, just say it's not about if, it's about when. And we've seen thousands of clients work to get there that weren't in the position in the first place. But I just wanted more than anything to say thank you. And underwriters are real people with real feelings, really doing a job that's critically important to the infrastructure of loans to make sure that we can do loans in the future. Because if investors come back and don't want to buy our product or don't want to do this anymore, and don't want to put money in here because underwriters don't do what they do, and all of a sudden there's a lot of loan defaults, guess what? Investors run from the run for the hills. There's no more money for us to do loans for new people or for you when you want to do it next time. So your role is so critical. So sorry, I went off on a rant, little deal rant in there, but do you have anything that's like, you just think, hey, it's super critical, other than, yes, I'm a person.
Yes, I'm a person. And one of the things that you will find is if we do challenge as underwriters, and I think most of us, when we come across anything that might be a little challenging, whether it be the income or whether it be the assets, we do a double check, a triple check, a quadruple check. We take extra time on that file trying to figure out what, if there's anything there we can do to make that deal work. Our last resort is always going to be denial. That's always going to be our last resort. So again, we try and do everything within guidelines. There is, we understand that a home is, a customer's pride. That's where they're going to raise their family. So we understand the importance of it. It's not, I don't want anyone to think that it's a piece of paper to us. We understand that there's another human on the other end, and we do our best, and we look at it from every single angle we can to make the deal work.
Awesome, Susie. And that is actually one of the just main reasons I want to do this is like underwriters people, we're making deals. Susie is the best underwriter I've ever had the privilege of working with. And I've been in the business for 28 years. She works weekends and nights and whatever it takes to get, not only just to approve the loans, to try to make sure they work, but to get them in the timeframes that this crazy industry right now is demanding for people even to get their offers accepted. We got to have approvals in 12 days. And, we have to have this. And Susie's at the other end of that. We're crushing it through. Susie's working her butt off to make sure we can really take care of our clients, and compliments to both you and Cornerstone. They say we have to take care of our families, and they're talking about the families we serve as well as our families. So thank you again, Susie. I know this is Texas time. You're into your personal time now, so I appreciate it. So thank you so much, which means she's going to have to still go back to work after this. So thank you for taking time out. Really appreciate it.
No problem. Thank you for having me, Tim.
You bet. Bye.
Thanks. Bye.
Okay, Stevie. How long was it? Okay, yeah, it's a lot of data. Didn't know how to abbreviate it too much more than that, but cool. Thank you.
Did I do all
That's
right?
And that's like 5% of it, right, Susie?
Yes.
5% of what we do.
I was general, and sorry, I didn't want to get into the F word.
Then you,
yeah.
Did you say get into the F word?
Yes, the F word.
What's the F word?
The fraud word.
No, I mean, people have to understand why we do it. So like, they don't get why we're making them miserable is because of the few. I mean, it's like everything else, right? The laws we have to follow, the underwriting, all that kind of stuff has to do because a few bad apples that, make things really horrible on the rest of us. We can be doing a fantastic job. We can be fantastic people, but our job is to separate those and make sure. And unfortunately, that's a reality of why we have to do this. Otherwise, we just go, oh, you got high FICO scores. You've shown that you got some money in the bank and you can do this. It's done, right? But we don't know if that's always 100% true. And because our industry is, there's a lot of fraud in any financial, right? Whether it's stocks, bonds, real estate, anything that has to do with big money, there's a ton of fraud in it. I think when I explain that to consumers, I love to have these kids or whoever, coming to these loans early on, understand why we're doing it, because they understand a lot better once they get why we're having to do it. And then we're not really questioning them, but we have a job to do.
Right.
I think that helps them understand, like, okay, maybe it's not that bad. I go get a bank statement. And I didn't say it on here, but the other thing is like, look, if I was going to give you $450,000, or you were going to give me $450,000 and you didn't know me from Adam, and that's what the underwriters and investors are, I go, what would you want to know if that was you saved up $450,000 and you're putting that egg over here for your retirement? Like, what would you want to know about those people and their likelihood of paying you back, kind of thing, right?
Right.
Oh, and then it kind of dawns on them like, oh, okay, you're right. That makes sense. I'd want your firstborn. I want this. And yeah, if you saved up 450,000, you want a hell of a lot more than we asked for sometimes. I'm just surprised, kind of, actually. So yeah, awesome. Well, have fun. Thank you for getting that one file done. Mr. Andre was very happy. Mr. Martin was very, very happy.
Good.
He says you kick butt on that Chase company. Kick butt.
Of course we do. I used to work for them. I'll gladly kick their butts all the time.
Let the realtor know. We don't think that's hilarious. All right.
Bye.
Well, Cornerstone's glad you don't anymore.
Yes.